Hi, I'm Bill Bronchick, and this video will describe the benefits of the Series LLC, the hottest thing to hit the business entity and asset protection field. A Series LLC is like any other, basically. There is a master entity that is a limited liability company. It can have one member or it can have two members. It can be taxed as a disregarded entity, meaning if it has one member, it doesn't file a tax return. In fact, no LLCs have their own tax returns, especially for LLCs. They file either as a partnership, as a corporation, or as a disregarded entity, in which case the corporation doesn't file anything. The members will file the income and expenses on their personal return. So for example, if you had a limited liability company with just one owner, one member, that one person would report the income and expenses of the company on his personal return, either Schedule C as a business or Schedule E, let's say, for rental property and interest income. A series limited liability company can form little cells or series below it to segregate assets. The general problem with just one entity is that if you have an LLC that owns multiple assets and one asset creates a liability, they will sue the master entity and you will lose everything the master entity owns. What some people do is form subsidiary LLCs, single member, that are owned wholly by the master LLC, but this can be expensive and time consuming. The Series LLC allows you to create cells, little series for each asset or class of assets, and that are segregated from liability from the master and from the other series. And in this regard, it is cheaper and easier because series aren't created by state. They're not created by a filing. They don't file a tax return. They're simply created by paper. You create a series agreement, and you give notice to the world by putting the series language into the deed, for example, if it's real estate, or you can file a public document with the county that would explain that there is a limited liability series. So for example, if you were having 4 or 5 properties, you might have a master LLC with Series 1 for this group of properties, Series 2 for this group of properties, and maybe Series 3 for other assets, and Series 4 and so on. Each series really can have its own members and managers separate from the master, but if it does, it may have a separate tax filing as a separate entity. So ideally, the way it would set up is you have your main Series LLC with probably 2 members as a partnership, and then create a series that is owned by that master. So therefore, everything passes for tax purposes onto the master entity. And you'd have Series 2, Series 3, Series 4, etc. Separate bank accounts. You can't rob Peter to pay Paul. That will blow up the whole thing, just like any other entity combination would. But as long as you keep them separate, as long as you account for them separately, as long as you have separate bank accounts and give notice to the world of the existence of the separate series, it really can be the ideal scenario for someone with multiple assets or multiple asset classes. Now, you're probably wondering, why isn't everyone doing this yet? Well, the challenge is the Series Limited Liability Company statute is not enacted in every state. It started in Delaware, they have them in Texas, and about 8 other states now. Now, can you create a Series LLC in Delaware and bring it to Florida, Colorado, or another state? Sure you can. The only question is that state going to treat each series as a separate entity for liability? And the answer is, it depends. If you treat each series as a separate entity, if you have separate banking, if you have separate records, if you have separate asset classes, and you give notice to the world of the existence of the separate series, either by communicating with your tenant in the lease that it's a separate series, for example, or by filing a public document showing the existence of the series, or for example, if you take a deed in the name of a series and put the notice of series on the deed, the setup should work. It should work in each and every state. Is it possible a judge can say in a different state that doesn't have a series statute that these don't exist and that everything is attributable liability-wise to the master LLC? Possibly, but that can happen even if you form separate subsidiary entities if you don't keep them clean and separate. You treat them as clean and separate entities and they will be treated by the courts in more likeliness as separate entities. Now, the fail-safe way to do it would be to have one LLC here for this group of properties, one for this property, one for this property, and all of those LLCs owned in full by the master. That would probably be pretty foolproof, and that's if you kept them separate, didn't rob Peter to pay Paul and gave notice of the existence of those separate entities. The challenge with that is each and every entity would have a state filing, an annual filing, and possibly, in such states as California, a separate franchise tax return. Whereas the series, unless, and by the way, California has already ruled that each series is a franchise tax. If you're trying to do this in California, forget it. Each series will not have a filing with the state and an annual filing, and therefore can be easier to create and fold one at a time through a series agreement. The series main LLC is filed with either Delaware, Texas, Illinois, or one of the other states that have it, and then you register it as a foreign entity in the state you want to do business, but each series does not have a filing until, of course, the state figures out that doesn't have the series, figures out that there is no filing, and they'll try to figure out a fee for that probably. But this can be proved to be the most effective strategy for a real estate investor by creating segregated groups, segregated assets that won't poison each other or the master. Now again, I'm going to remind you, you must treat them as separate. You can't take money from the master, put it in a series, and rob Peter to pay Paul between series and between the master, and vice versa. If you do that, the whole system will probably fail. If you keep them separate and segregated with separate books, separate records, and separate bank accounts, then in all likeliness, this should stand up in a court of law, and it will give you the maximum segregation and the maximum liability and asset protection. This is Bill Bronchick, and I hope you've enjoyed this discussion on series limited liability companies.